G'day and welcome to Shares for Beginners on Facebook Live. I'm Phil Muscatello. Thanks for tuning in. This evening I'm pleased to welcome my first guest, Andrew Page from the online investing club Strawman, where members share research and recommendations on ASX-listed companies. By ranking content according to performance and community endorsement, Strawman provides peer-reviewed investment insights. Please send in your questions via the comments. Good evening. Welcome everyone and thanks for joining us on this Facebook Live. Hey Andrew, how's it going?
Hi Phil, how you going?
We're a little bit nervous because this is the first time we've tried a Facebook Live, but it seems to be working. So I'd like to make an introduction tonight. Well, as you know, on the podcast on Shares for Beginners, we always talk about single stock shock and the problem with lack of diversification and the problems with dealing directly and trading directly in stocks themselves, which is why we always talk about ETFs, because ETFs are easy for diversification, they're set and forget. And Warren Buffett thinks they're great. In his will and testament, he wants all the money from Berkshire Hathaway to go, basically, was it 90% of ETFs and 10% bonds, something like that? Mm-hmm. But there may come a time when you want to research, and you want to research individual stocks because you want to try and outperform and get some of those big gains. Which is why it's my pleasure to introduce Andrew Page. G'day, Andrew.
G'day, Phil. Thank you.
Okay, so you're with Strawman. We just heard a little bit about Strawman in the introduction, but tell us about yourself and about Strawman.
Yeah, okay. So I'm a passionate private investor, first and foremost. Have been for years. Mm-hmm. A bit over 7 years ago, we sold our house and we put all of our money into the market. But
that's really going all in, isn't it?
It really is. I mean, it always gets a reaction when I say that because mm-hmm. it sounds as though you're doing something extraordinarily risky. Yeah. But we've really tried to approach it a very sensible, level-headed kind of way. And it's the main vehicle for our wealth creation. Touch wood, it's done very well for us so far, but
you're from a scientific background, though, aren't you?
Yeah,
you're a scientist originally.
I a degree in microbiology, which I never used, as it turned out. But
so you're a data-driven kind of guy, aren't you?
I'm an evidence-driven kind of guy. I think that whether it's investing, politics, or anything that if we're going to ignore evidence, then we're probably in pretty poor intellectual grounding. So I'm open. I like to think I'm a very open-minded guy, but I'd like to see evidence of things working before I sort of buy into those kinds of things. But it was a wonderful grounding for investing. And then there's a lot of scientists or people with scientific backgrounds who do become investors, I think, because there is similarities that are there. But yeah, so I've been doing that for a while. A couple of years ago, we launched Strawman.com, originally as a very rough beta version, and it's been going really well. We've passed 11,000 users recently. Very active user group. Basically a forum where people can interact as they would in an investment club. We allow people to sort of share ideas, insights, recommendations, paper trade a $100,000 paper money portfolio to gain some experience and share some wisdom, and hopefully that's going to keep growing.
Okay, now we've got our first technical problem. It's double playing with a delay. Fixed now. Didn't do anything.
Okay, that's Facebook. Okay. That's on Facebook.
Thanks, Gary, for pointing that out to us. Okay, so look, we've got a little bit of an agenda before we get started onto the questions. Well, we've got a couple of good questions. Oh, Andrew, I bought NAN. What's it? Nanosonics.
Nanosonics.
Yeah, on your advice 2 years ago. Thanks. Do you think it's reasonably priced now?
Josh, that's a 2% management fee on that. So I'll give you my bank details so you can send that through. It doesn't apply when the recommendations don't go well. I still hold a few Nanosonics. The best thing to do, I think, right at the beginning is I prefer not to get too much into what I think you should do here.
Yeah.
That being said, Strawman's very much set up for that. You can go to Strawman, look up the username Strawman. I should have probably gone with a different username. But if you look up Strawman, you'll see all the stocks I'm holding, all the ones I'm recommending. And if you want to know what I think of a stock, if it's there, that's probably the best place to look at it. Nanosonics is a really wonderful business, and I think their best days are to come. The trouble with Nanosonics, as with so many stocks in this market at the moment, is that you've got these really nice businesses, really strong growth prospects, but the market knows it, and the market knows it and then some. And the difficulty I think we have for a lot of these companies is that you can actually find yourself in a situation where the company actually delivers really good returns, good growth. You can still do very poorly as an investor. Nothing is worth an infinite amount. You have to watch what you pay. And I feel as though a lot of these stocks are sort of up against what is reasonable. That being said, a lot of the value that's being argued for is very much based on what these companies look like in 5 and 10 years' time. And the nature of these businesses and in the way that they scale and the operating leverage and everything that they have is that you can actually get some really spectacular growth over that period. I just think that if that is the basis for your investment thesis, and you're saying, I'm buying Nanosonics, Afterpay, Xero, Pointera, whatever it is, because in 10 years' time, they're going to be $100 million revenue kind of company. Well, you kind of got to sit through that 5 to 10 year period. Too many people sort of start with that as a rationale and justification for buying, and then freak out the moment it drops 30%. Or get impatient, or maybe they think they're clever and then will lock in a 10 or 20% gain after a few months. But I think in those kinds of timeframes, you're at the will and the mercy of whatever crazy thing Mr. Market is going to do. So if you are a long-term believer in the opportunity that these companies are presenting, you kind of have to be with it for the duration to have those returns realized.
Actually, what we haven't covered, for people who don't know what Strawman is, tell us a little bit about Strawman.
As I said, it's just an investment club. We try and make
just an investment club.
Look, you can use there's a lot of language that we can use, platforms and social media,
startups and
all of that stuff. It's just the whole starting point. Well, I used to work for a high net worth investment club, and it was just such a wonderful experience. You get a lot of engaged people together, various backgrounds, various experiences, but we would talk shares. Everyone was able to sort of bring their own view to the table. We'd all vote on it, and then everyone would leave, and it was all care, no responsibility. You do what you think is right. So it wasn't about sort of, I'm going to join this group who's going to tell me what to do. It's I'm going to engage with others to improve my thinking, test my ideas, and that was a really valuable experience. So I wanted to sort of take that online and do it in a way where you can sort of have those collaborations without it getting very messy and cluttered and jumbled and full of noise, which tends to be the problem that most forums have.
Forums, because there's lots and lots of forums that you can go to, but they're not very user friendly, and you've kind of got to have a persona, and you've got to be angry a lot of the time, and a lot of ego,
a lot of rocket emojis, and this one's going to the moon. There's just no substance.
A lot of pumping.
A lot of people with interests who may not be aligned with yours. So it's just a matter of saying that there is wonderful community out there of private investors, but we wanted to be able to allow them to share their ideas in a way that got rid of the noise and gave accountability. So if you jump on Strawman and you're looking at someone, you can see what they've said, but you can also see how they've performed. Is this someone who is worth listening to? Is this someone who's got a track record? Or is this someone who's just on here with an agenda? And that's what it's trying to accomplish.
And it's also about showing how shares are researched, the kind of things that you do need to know about buying a share, and what decisions you should be making beforehand, and what you should know about the
And we're a broad church too. There's no one particular way of going about it. I really think that the value, I say to members a lot, that you should put your thoughts out there. Not so much for other people, but for yourself. When you've decided to buy Nanosonics, for example, a lot of us will make that based on a lot of subjective thinking. We have a bit of a feeling for it. If we do a lot of reading on it, the very act of writing down your investment thesis, your investment expectations, roughly what are sales and earnings going to grow at? What do I understand about the business? What are the risks? The very act of writing it down will clarify and crystallize your thinking like nothing else. And especially when you're doing that in a public forum where other people are going to see that and vote on that potentially, it forces a discipline that you might not otherwise have.
Mm.
And then when the future unfolds in random and unpredictable ways, as it always does, you've got a touchstone to refer back to. I bought shares in company XYZ 3 months ago based on these assumptions.
Mm-hmm.
What's changed to alter that? Maybe things are going better than I thought, or worse than I thought, or maybe really, in most cases, nothing has happened. But it helps you distract you from the noise of the market and the up and downs of share prices, and like, this is my reason for buying. This is the value that I think is there, and it'll make you a much more disciplined and honest investor, frankly.
Yep. Okay, so let's go through your checklist. Oh, we've got 29 people on at the moment. That's nice. Welcome to you all. I'll just hide
Thanks
this.
for joining me.
Okay, so we're going to go through your checklist. Actually, before we do the checklist, I just wanted to give a shout out to Rory Watling, who's joined this group. G'day, Rory, if you're watching. Now, he wrote when he joined up and said, I'm considering investing now at 19 for the long term. So I'd like to hear all about different ETFs, index funds, and stocks that will prosper over time. So, Rory, all we can say is starting at 19 is fantastic.
Massive advantage.
Yeah, you've got so much time on you. That's your secret sauce, your secret weapon is time in the market.
I heard a stat the other day. It's one that often gets quoted. Buffett made something like 90% of his wealth after 55.
Yeah.
And the reason why he's someone that everyone knows is, he's had good returns over a long period of time, but it's because he started so early. And, things in this game can get very unnecessarily advanced very quickly. But if you spend less than you earn, you make regular contributions into a broad-based ETF. You do that when markets are good, when they're bad. And you do that, it's not a 6-month fling. You do that as a financial habit for 10, 20, 30 years. The compounding effects are just insane. Jump on Excel and do some basic numbers there. It's a guaranteed get rich slow. Unfortunately, it's not a get rich quick. I wish it was. But the reason why so few people do it is so few people have the emotional temperament and have the patience. In fact, if you've got those two things, you've got such a substantial advantage on everyone in the market, even the professionals, which are often running under an institutional imperative that doesn't give them the luxury of time and patience a lot of the time too. So starting at 19, phenomenal. I wish I did.
Just do it $20 a week.
It's huge. It makes such a difference.
And
then as you get older and you get better paying jobs and all the rest of it, that $20 a week can become $50 a week, whatever it happens to be. And it is magic.
And in that time period, now I can't remember her name, but she joined up on the Facebook group this week. And she said she's 44 years old. She's broken up from a 30-year relationship. And saying she hasn't got that much time in the market, but really,
heaps of time.
Yeah.
Yeah.
You have heaps of time.
There's an old saying that, the best time to plant an oak tree was 50 years ago. The second best time is today. It's unfortunately we can't travel back in time, but there's probably another 20 years left in the workforce for someone in the mid to early 40s, and a lot of special things can happen when the market is we up 60% 1 year, down 30%. But on average, there's different figures. But if you count dividends and the rest of it, it tends to be around about 10% per year. And if you can compound your wealth at 10% per annum over 20 years, you'll have a very comfortable retirement.
Yeah, that's right.
It's going to take a while.
Don't forget the dividend reinvestment plan either.
Yeah, it's very nice. Yeah.
Anyway, so now we're going to talk about buying individual shares, and we've got the 5-point checklist, I think.
It's a very broad checklist.
Yeah, it's a very broad checklist, but I think it's worthwhile going into. So the first one is, and it sounds like a silly question, do you understand the business?
If you don't, and there's no shame if you don't, I'll put my hand up. There's a great many number of companies I come across on the ASX which just I don't get. I can say, yes, they're a retailer, or yes, they're technology. I can give you the industry classification. What's the business model? What are the drivers? What are the industry dynamics here? What are the competitors like? Who are the customers? What are the needs of these customers? What's the funding available here? What is the sales onboarding process? There's a million questions that you need to ask. And unfortunately, very few people do. But having a good understanding of a business not only sets you up to make better decisions, but it enables you to react to news much better as well. When you very much understand a business, and even the best businesses will have a rough quarter, a rough half, and they come out and they say this, you'll be able to contextualize that very quickly, and not make silly short-term decisions on that. But none of this comes. The market is there to serve. It is not there to inform. You know, if you're going to let the market tell you a stock is good because it's gone up, or it's gone bad because it's gone down, which will do all kinds of crazy things in the short term, you're never really going to have an understanding of, is this good value or is it not? You have to know the business. The next question, I guess, that comes from that is, well, how do you do that? There's no one sort of checklist here, but the real reality of it is it just involves a lot of reading. And a lot of my friends and family find that really boring, which is fine. You know, it is for a lot of people. Great, invest in an ETF and don't bore yourself with that stuff. But I think you have to have an enjoyment in it and an intellectual curiosity. And I love the process. And I think for those that enjoy it will inevitably do better at it, because it's not work. It's fun. It's intellectually stimulating. But you'll read the presentation decks. You'll read the annual reports. It doesn't have to be cover to cover. But, you know, I would want to, I like to imagine that I am the outright owner of the business. And, you know, every now and again, management come forward and give me a briefing on how my business is performing. What are the things I want to know? What are the things, what are the prospects and expectations? Have they changed recently? All of that kind of stuff is just super important. And you just have to read a lot of material. But it's all out there and it's all for free. You know, the ASX.com give you all ASX announcements, companies' own websites. And the other thing with that too is that knowledge compounds. If you spend a lot of time doing a bit of work on a particular sector and a particular company, there's a lot of lessons and insights there that will translate to other companies. So, you know, next time you go to look at a medical device maker, or next time you go to look at a banking stock, or something, all that work you did previously is still there. And it's like exercising. You just get better and better and better and better at it. So it's even, and this happens a lot too, you'll do a lot of reading on something only to realize that you don't like it. And it feels like wasted effort. But it's not.
That's good. It's a process of elimination, really, isn't it?
It is. And then you build up this diary, really, these notes that just are a wonderful resource. Again, allowing you to get better and faster at it each iteration.
Okay, I just wanted to say hi to Trudy, who wants us to say hi to some of the followers. Hi, Trudy. Don't look over there.
Oh,
Yeah, no. And your previous question, is this purely for beginners? Possibly not. But what we're trying to do is, I think, by listening to the way experts talk, you're getting via osmosis some really good advice here, because these are the kind of steps we're trying to provide a pathway ahead for you, aren't we?
We can get into the weeds, though. We can get more advanced. And in fact, as
I think maybe we're saying we're too far away, too far into the weeds.
Okay.
Is that the case, Trudy?
Well, I think we just want to be driven by the people who are watching. So if you've got a particular question, we'll get as technical or as not technical as you want. I guess one thing I would say is that having worked in the industry for 20-something years, that my learning has been that usually the more esoteric, advanced, and sophisticated an investment approach is, the worse it tends to be. Keep it simple is a very good approach when it comes to investing.
And I think one of the points about this, what we're talking about now, is, do you understand the business? Trudy, how many times does someone come up to you at a barbecue and say, oh, you know, let's invest in blah, blah share? And you go, well, what does it do?
I don't know, but the price is going up.
Yeah, the price is going up. Everyone's jumping into it. It must be really good. It's like the whole Afterpay scenario. And I think what we're trying to teach is that that it's more than just tickers, more than just numbers on the screen. And you've just got to take this into account.
Yeah, 100%.
Now, just before we go on to the next one, I just wanted to say hi to Trevor. I didn't know Trevor was Canadian Aussie.
Hi, Trevor. Yeah. Real outstanding member on Strawman.
I know he does his research, doesn't he?
Yeah.
I remember reading the other day, he was saying, someone asked him, and he does about was it 10 to 20 hours worth of research? Is that right, Trevor? On each share. And okay, so what was the question?
Love to hear that.
As someone who also has a background in science, do you have any advice for someone wanting to transition from a career in science to investing? Or could you talk briefly about how you did it?
It's a really crazy story. We might have said it when we did the podcast. I applied for a job in the newspaper. This is how long ago it was. And it said, you want to be a stock? Yeah, just this black and white thing. Yeah. It said, do you want to be a stockbroker? It had some number there. It ended up being a recruitment agency for ComSec. And they were growing really rapidly at the time. And just basically anyone with a degree they were hiring.
Oh, that's right. You accidentally fell into it.
So I just completely fell into it. And have hated a lot of it. Touched on before, the institutional imperative within professional investing organizations is just very depressing.
Yeah.
But it was a real sliding doors thing, and I don't know if I would technically qualify to get into the industry now.
Yeah.
But I would say that of all the great positions out there, some really wonderful boutique fund management organizations and this other kind of stuff, they of the really good operators I know, they put a lot less emphasis on the formal qualifications.
Yes.
What they love to sort of see are people who can actually demonstrate a bit of a track record and articulate an investment thesis as well. So I think if you build up a bit of a resume on terms of your investing track record and that kind of stuff, I think that'll go a long way.
So would you give Trevor a job?
If I was hiring, yes, 100%. Yeah.
There you go, Trevor, you got a job. Okay, so hang on, there's another question.
I mean, there's one thing you can't train for is just curiosity.
Yes, that's right.
And the emotional element of investing is super strong as well. So frankly, if I was running a fund and I had someone who was ravenously intellectually curious, honest, humble, and all of those kinds of, I think that would, to me, far outweigh anything else. And a good emotional temperament. I think that would be some of the most important things I'd look for.
No, that's interesting. And what I'd say, and something that I've noticed in the industry, is in the marketing side of things. And I know this is traditionally a women's role, but there are men that are getting into these roles as well. They really need people who have the skills in social media that haven't existed before in this industry. You know, there's so many ETF providers that are coming up now, and so many new boutique funds like you were talking about. And you can't just market them the way that they used to by having a bit of a brochure that they would give to some retirees. It's much more about social media.
Really fast.
Yeah. So I'd really encourage people, you know, some of the places where I've met people in the industry, you know, ETF providers, they seem like fantastic places to work. They pay really well, and you've got these skills, which you've got blue sky to use these skills because they're not used to using them.
Yeah, definitely. Just get in there and give it a go.
Okay, so let's keep on. How many questions have we got? Why don't we do a couple more questions? I mean, we can come back to the checklist.
Let's checklist online.
Okay, so Trudy, thank you. I love your website as well. Okay, Hari Kanta Acharya. What do you advise for a 40-year-old? Still better to invest in ETF? I don't understand stocks market much. Just started investing in ETFs, FANG and VAS. And we should say here that we can't give individual advice. We don't know what your situation is. It's really, I guess, what are the questions that Hari needs to ask himself before making any more decisions?
The trouble about giving advice is as well is that you can give someone an idea. You can't give someone your conviction. And for those that really realize the better long-term gains are those that are able to sort of hold through very difficult periods. And you will only get that conviction if you sort of take ownership of those decisions. So it sounds like we're just trying to avoid the question, but it's actually, you can't avoid it. It's really fundamental to the whole process. But to answer generally, 40 years, you've got decades left. And the great thing about ETFs, you don't have to understand anything. As I said before, spend less than what you earn, regularly make contributions into some broad-based, low-cost ETFs, VAS and FANG. There's mentioned some great ones. Just keep doing that.
Yeah.
You know,
because it's kind of like the base level, isn't it? The base level is an index tracking ETF. That's it, isn't it?
yeah.
And really the trick is to find the lowest cost one, isn't it?
Lowest cost, broadest diversity. I think, you know,
Yeah.
you can, there's a lot of very hyper specific ETFs for people who want to take a specific position on gold, or they want to go short the Nasdaq or something like that. They're more esoteric trading products,
and you shouldn't be doing that as a beginner anyway.
I would argue not.
Yeah,
a lot of professionals probably shouldn't be doing it either. But for the viewers' question, that is all you need to do.
Yeah.
2 or 3 broad-based different ones, and you'll be fine. This isn't about sort of looking back in 20 years' time and saying, I got the best possible return that anyone on the planet could have got. It's sort of basically saying, can I do much better than I could in other asset classes? Investing is all about opportunity cost.
Yeah.
And if you can look back in 20 years' time, and you know, even if you've averaged 7-8% compound, it's wonderful. Job done. And you can spend your spare time doing the things that you love.
That's
You don't have to be reading annual reports if that's not your bag.
I mean, you only want to read annual reports if you really want to. If you want to geek out, like you know. Trudy Jenkins, we'll give you a job anytime. No, we got Francis Fogliani. That's
another Strawman.
Yeah, yep. That's the hardest thing to say in Italian. There's a Fogliani. Okay, io parlo italiano con molti errori. Okay. Hey, Andrew, Francis Fogliani from Strawman here. I'm a newer member, and although doing research before buying, I feel more like I'm stumbling into luck than picking winners. Do you have any advice for beginners that have success early?
Oh, what a great question. Yeah, it is the hardest thing to really own as an investor, that you can buy a really bad share for really bad reasons and do really well.
Yeah.
And you can buy a really good share for really good reasons and do really bad do really bad in the short term. So we get all these false signals, you know, and I think Francis makes an excellent point to sort of acknowledge that maybe there has been some luck in that. And I think anyone who's really entered into the market in the last 6 months has to understand that there's been a Johnny on the spot phenomena. And I put my hand up for that as well. It's been a great, really great 6 months, but I never anticipated what was going to happen over that kind of time period. So I would just basically say, again, go back to basics, stay grounded, write out why you bought the shares, what your expectations were, and contrast what's happened with what you thought. And just keep using that as your touchstone. Recognizing that this, 30% gains in 6 months or whatever it happens to be is not normal, is a very important thing as well. So as someone who's had a lot of luck, and I would probably say to Francis, well, give yourself some credit. Like this, it's not all luck.
It's the company you keep.
Yeah, it really is, you know. And I would basically just say that another really important trick with investing, Phil, is to decouple yourself from the past. The share market doesn't know what you paid for your shares. It doesn't care, and it doesn't matter. You know, you've got to imagine that you spring into existence every day, and this is just the shares I'm holding in the proportions that I'm holding. And what you really need to do is sort of say, is this sensible positioning going forward? So some people will be sitting there who happen to buy Afterpay at $8 not that long ago. It may have grown to 40% of their portfolio. And you would say, that's great and well done. But if you started investing today, would you build a portfolio that looked like that? That is, with Afterpay at 40% weighting at current valuation. I'm sorry to pick on that particular company. I'm not trying to make too much of a specific point on that, but more generally speaking. So I think it's just a matter of reevaluating things regularly, but not fiddling too much as well, because that can be equally as dangerous. You know,
I think also one thing to watch out for is trying to predict the future, because no one can predict the future. I mean, over the last few weeks, I've had one fundie get on the phone to me and say, I want to talk to all your listeners. This is going to be the greatest depression ever that we're going into.
Maybe he's right.
Maybe he's right. And then I talked to an economist, and he's saying, well, after World War I and the Spanish flu, we had the roaring 20s.
And you know what? They both make compelling arguments.
They do.
And this is the thing. On the share market, if you go looking for a positive analysis of a particular company,
Mm-hmm.
you'll find it. And if you want a poor analysis, you will find that as well. So again, this comes back to this idea of really taking ownership of your decisions and building that conviction. I think, unfortunately, with investing, you can't avoid making predictions. You have to make a prediction, but you can still be smart about the things that you make predictions on. So I can say, I think, let's go with the first example, Nanosonics. I think in 5 years' time, it will be a bigger company, that it'll be more profitable. I don't have my notes in front of me, so I'm not going to be able to give any numbers. And that the market will probably attribute a reasonable multiple to that business, given how I expect it to perform.
Yeah.
And if I can be general with those sort of assumptions and apply a very large margin of safety, it's probably a far more useful process than saying it's the 1st of September 2020, and on December 13, I think the share price target will be this. Both are forecasts, both are predictions. One is predicting something which is inherently impossible to predict, where the other is something that a reasonable person can have a reasonable view on.
Yeah.
Now, the good thing about the way that I'm talking about it is Pointera, I'd love to get to, is a great example of that. It's
well, why don't we talk about Pointera?
Sure,
because you've come prepared to talk about Pointera.
Well, and I have to say, there'll be a lot of people on Strawman watching. It was a 30-something% gain today. This thing was picked up by our community about a year ago. Sort of like,
did you find it, or did someone else come up with it?
I'm going to take credit for this.
Yes,
I think I was the first one.
This is all yours.
But I think it's going to sound like a big wind up to do a victory lap, and it's not. I just think that there's some really good lessons in how all of that has kind of worked. And just to finish that previous point, I think when I was buying it last year, and other people were as well, is no one had a forecast on what the share price was going to do, or that Bevan Slattery was going to buy shares and that was going to spark a re-rate, and none of that. But if you go back and you read those comments from people back then, people did have a view on where the annualized contract value would be, what the market opportunity was. And they had some general notions of that. And then they applied very conservative multiples and discounted back and applied margins of safety. So you can be generally right and still do well, but you can be specifically wrong and do very badly. And so when it comes to making forecasts and predictions, they are unavoidable, but you can choose the things that you're trying to predict, and you can be very loose in the kinds of things that you're trying to predict for. I'm not going to give you 12 decimal places to the earnings per share of Cochlear in 3 years' time. I don't know. But I've probably got a reasonable sense of how earnings are going to grow over that period.
Yeah.
And as long as my valuation and my investment thesis isn't based on some hyper specific kind of number, if earnings are up 30%, pick Cochlear again as a random example, in 5 years' time, or they're up 25%, or up 35%, that's all of a general flavor that is probably going to do you well as an investor. Now, if earnings are down 30% in 5 years' time, or flat over that, that's a very different, qualitatively different story. So I guess what I'm trying to say is you need a general direction, you need a compass, you need a general target for what success looks like for a business, but don't take yourself too seriously, because you can't predict the future. And the more hyper-specific you get, you see it on TV and stuff sometimes. Someone will say, I love this company at 23 cents. If it gets to 21 cents, I'd buy, but not now. It's
I know, there's no reasoning behind it. That's like,
if it's a good business at 21 cents, I mean, yes, there is a line you will cross at some point, or a zone that you will transition, but none of us are that good. And to talk about Buffett again, he does some very broad numbers in his head, because he's not trying to be hyper specific. He's just trying to get the general theme, the general direction right. Yeah, and that's what you need to focus on.
Actually, we got a couple more questions here. Nice call. Oh, Trudy loves Nanosonics. Worried about TWE, but could be a bit under $9. Don't know. TWE. What's TWE?
Treasury Wine Estates.
Oh, okay. Right. Yeah.
So these guys had very big potential in China. Big market, demand for Australian clean and green, high quality.
But there
products.
could be headwinds at the moment.
There's political issues and all of that kind of stuff. I'm not close enough to it, but it looks. It's a real what it is, and this someone's mentioned the checklist again, so maybe
Yeah,
I'll
yeah,
segue back to that.
well,
Is that one of the other points there is focus on the risks and focus on the downsides, and I think as investors we get an attraction towards a stock for sometimes really good reasons, and then we naturally as humans we suffer, all of us, from confirmation bias. We like to hear things that resonate with our preconceived
No, it's the
notions.
worst thing, isn't it? Just
It's
only
awful.
looking at stories that confirm your view.
Yeah, discounting everything.
Everything else, yeah. Which is what a great thing about Strawman is, because you're going to have the peer review of a community that's going to look at your ideas and say, well, have you looked at this situation?
Well, we called it Strawman because we want the ideas to be challenged.
Yeah,
it's not about ego. It's about being right. And
sorry, I missed your point.
The point is really is just to, and Treasury Wine Estate sort of reminded me of this, is that the investment thesis would have been very well established company, good established brands, long record of profitability and dividends and all of this kind of stuff. But the real growth avenue was China. And if that can proceed as people are expecting, you'll do very well.
Yeah.
But a lot of people got so carried up in that they forgot that, well, actually maybe China won't be a success. And historically, Australian companies going offshore don't do well. Not because Aussies are bad at business, but it's just very hard. Different markets, different dynamics, different systems, really, really, really tricky. And so every day there's a company going into China saying, "Oh, if only 1% of China buys our product, we'll make squillions." But most don't.
Yeah.
And it's not. You need to ask that what if, and if that doesn't, what does that mean for the share price? And you're trying to find some, I certainly am anyway, asymmetry in your return outlook. So you want something which, if it goes right, it'll go really nicely for you. But if it doesn't, the downside is limited. So Monash Pabrai, famous Indian investor, calls it heads I win, tails I don't lose too much. You want to be making those kinds of bets. Yeah. And just to pick on poor old Afterpay for a moment, and yes, I don't own shares, which is why I'm bitter and jaded for missing out.
I know, I sold at 20 something.
It's who'd have thunk it? But but the problem is that this what I would be asking now is that, yes, I get the bull case. This is going to be a structural shift in payment systems globally. It is a massive market. They're capturing huge amounts of market share. And the sky's the limit. But ask yourself, well, what if that doesn't occur, or at least not to the rate that we expect? Or what does that look like? Or
what, as Trudy said, do you think PayPal installment plan will have a long-term effect on BNPL? I mean, these are so many things can just suddenly happen, like, a trade situation with China, politics with China can change the situation. Another player can come in and just, BNPL is not a very difficult thing to do, is it?
Not when you're the leading payments player globally. I mean, PayPal, right? So again, you hear this phrase on the market a lot, priced for perfection, which means that it's no good just giving a favorable outlook on the business. The market's assuming that. The market has priced that in. To do well, to do really well, you not only have to see the market perform to these lofty expectations, but to exceed them. And let's say things do go really, really well, maybe even a little bit better. Well, then you've got X upside. But if it doesn't, you've got this asymmetry on the other direction, whereas there's far more downside than upside. And you're dealing in a world of probabilities here. And as I said before, you can get these situations where, there was only a 10% chance of this company making it and 90% that it failed. But you know what? The 10% scenario played out. You deal with these things that will seem super obvious. But I think now when you're looking out, what's the upside? What's the downside? Which way do the odds sort of swing for me? But consider that downside, factor in those risks and take them seriously. If you can't argue the bear case better than the bears, you shouldn't be owning the stock. You don't need to agree with it, but you need to, if someone was to say to you, what can go wrong? You need to be able to articulate that. And you need to be able to articulate it for yourself too, because there will come a time when the shares aren't performing so well. And you'll think of all kinds of reasons to preserve your ego and rationalize, and you can average yourself all the way down to zero. But if you've said in advance, this is what failure looks like, and objectively measure that and objectively compare that to your prior expectations, you can make much more objective and sensible decisions.
Callum Dillon. Let's put him up on the screen. Okay. Hey, guys, enjoying the chat and keen to hear the rest of the checklist too. We'll try and do that. Quick question on value versus growth. I've heard recently things like value investing is the widowmaker trade, etc. Do you feel like value investing is still a valid ...
Only fits so much on screen. A valid approach in 2020.
There it is. Yeah.
Yeah, Callum, it's an excellent question. I hate the distinguishing between the two.
Yeah.
I'm with Charlie Munger. I think all investing is value investing. You know, a growth stock. I still want to get value when I buy a growth stock. So I think these terms get confused and people use them in different ways. So traditionally, back to the Ben Graham days, people might have called a value investor who bought a business that was below its net tangible assets or very low earnings multiples or these kinds of things. And growth was things where you might have very, very high multiples and the valuation was sort of going to grow into itself. But I would say if you're buying the most growthiest of growth stock out there, you still need to have a view on value. At what point is this no longer sensible?
Yeah.
And there is a point. You know, maybe it's $100 above where we are now, or $1,000. But at a point, you know, if I could buy, I don't know, what's one of the best companies in the world, Amazon or Google, and you said it was $1 trillion a share, I mean, I'm not going to buy it. It's ridiculous. And so logically, between zero and some insane level, there's a point which is stupid. And value is always, I would argue, always a consideration. That might be argued against very high rates of growth and high multiples and the rest of it, but you have to have that value lens. So I'd say value as a concept is always applicable.
Yeah.
I mean, otherwise, what do you? I mean, if you were going to buy a house or you're going to buy a local corner shop,
that's right. Yeah.
You're going to value is this thing that is in the eye of the beholder, but you will have a view on that without some external market telling you what other people think it is. And it's this, I think people get a little bit silly with all of these kinds of things. So pretend you're a billionaire and you're buying this thing outright and it's not quoted on the ASX. Someone's just come up to you and said, hey, I've got this business. This is what we own. This is what we think we can do. Would you like to buy it? And you need to come up with a value. You're never going to come up with the real value because no one can. But if you can't even start or even have a thumb suck at it, you just shouldn't buy it in the first place.
Yeah. Okay, well, let's go through the rest of the checklist quickly. And just to keep in mind as well, this checklist is on the Strawman blog. And I think I've got a link on it on the Facebook page. And anyway, there will be links to it so you can go into it again. So we've been through, do you understand the business? Now it's, what are the risks? So we've really covered.
We kind of did the risks.
Yeah. So it's you just really working out what, having a clear idea, I think, isn't it, what those risks are?
Yeah.
And arguing the contrary case to the business and limiting that downside.
And then saying, what are the consequences of this risk? And what's kind of useful here is just playing out various. And I talked about valuation before, which is another point on the checklist. Is people feel as though you have to come up with a value and that's the value for you. But it's really useful just to derive a number of figures. Here's my hyper bullish forecast. Here's my pessimistic one. And just the exercise will give you a sort of a scatter of different outcomes, which will help you balance things out.
Thanks, Trudy. It's like she's like the peanut gallery. Thanks, Trudy. We're enjoying your commentary.
I think the really just traditional concept of value is definitely struggling.
Now, okay, so is the balance sheet in good shape? This is another thing. And another way that might be worthwhile looking at in this question is how much debt does a company have? Is that the basis of what this is?
Look, I think you could simplify it down to that. You know, businesses that have very leveraged balance sheets.
That's a lot of debt. It means a lot of debt.
Think about it like you or I would think about it. If you or I borrow 95% to buy an investment property, so $1 million investment property, we put in 50 grand and that goes to $1.2 million. You know, we've made 200 grand profit on a 50K investment. It's great. Well, same thing works for companies. They've got so much equity in the business. They've got so much capital they can deploy. if they've got a wonderful machine for generating returns on that capital, they can borrow a heap and they can do really well. But if they don't, they get to a situation where they've got this huge interest bill, they can't pay back the loan, things get more difficult. This is where businesses get into real trouble. So debt isn't a four-letter word. Debt is perfectly justifiable. A lot of great businesses have debt.
Yeah.
But you want to have a view as to how significant that debt is. How is that balanced off against the cash flows of the business? How is it balanced off against other cash and hard assets in the business? I mean, debt is really one of the few ways that a business can get into serious trouble. The great thing about businesses with strong balance sheets as well is that when times get tough, like the COVID crisis, for example, a lot of businesses sailed into Nanosonics comes up again, Fortress balance sheet, I have $90 million in cash or something.
Yeah.
They don't need to raise. They're not dependent on the good nature of bankers to sort of see them through this crisis. They actually find that companies with really strong balance sheets find that when cycles do turn and all their competitors get really hard done by, they're in a position of strength like you can't believe. So it just removes a massive risk. And even if companies manage to avoid bankruptcy and that kind of stuff, and we've seen this a lot recently with companies having to do extremely significant, extremely discounted capital raises to stay afloat. So there's a dilution risk there. So look at that balance sheet. And again, there's so many great resources online for accounting 101 kind of stuff here. You don't need to be a chartered accountant to do this kind of stuff. What's the cash? What's the debt? What are the liabilities of the business? Go back a few years, have a bit of a look at it. And if it is too highly leveraged, doesn't mean that it's going to go bad, but it is a risk you need to be aware of. So yeah, balance sheet is well worth looking at.
Now, the other, I think I just missed this one before, is do you trust management?
Yes. Yeah.
How can you know?
You can't.
You can't know because
unless you know them personally.
It
is difficult, but there are some wonderful signs. Money talks and BS walks. So when you've got management and insiders buying shares in a company, and have substantial interests in the company, and have bought those shares with their own money, not been gifted them as free as part of a remuneration or short-term incentive package or something.
That's a very clear sign. It's a very good sign, isn't it?
Doesn't mean the business will go well.
Where do you find that information?
Oh, it's in all of the published reports. So you'll see change in substantial notices.
It's the last page. It's almost the last page in an annual general.
They'll show you the top 20 shareholders. But even if you just look at the directors report, you'll see often the shareholdings that they've had. Anyone who's a substantial holder of more than 5%, that has to be published. Any director interests has to be published. You'll find it just by looking at the announcements. So I think that's a really wonderful sign. The flip side of that, though, is a little bit more complicated. It's wrong to assume that if a director sells, that's automatically bad. Now, if there's a pattern of selling and a lot of directors are selling, that's one thing. If someone who has got 99% of their family wealth tied into one company, who's probably worked for 20 years behind the scenes to grow this, as a founder, and then one day decides to finally take some money off the table, people see conspiracy theories everywhere with this kind of stuff. And while there are definitely some bad actors out there, in my experience, I'm reminded of the saying, which is that insiders sell for many reasons, but they buy only for one. And I think that's worth remembering. So definitely keep an eye on director and insider transactions. We don't like to see them selling, but it's not an automatically bad sign. But buying is a very strong sign. I think that's one way of trust, because your interests are just aligned. The other way is again, just reading, as I was saying before. So often people will look at the last announcement or the last presentation day. Go back 5 years. What were those guys saying 5 years ago? I mean, how realistic has that been? Every business, even really well-run ones, will just have bad periods. Do management take ownership of those mistakes, or is it everyone else's fault? Is there a lot of churn in the management team? Again, just reading all the correspondence that a company sends out, you get a really good feel for whether you can trust management. And I generally like management that are just very realistic, very long-term focused, making capital allocation decisions that aren't based on trying to beat the quarterly consensus forecast. They're making capital allocation Jeff Bezos style. 20 years out into the future, as the decisions that they're making. Seek is, by the way, a really great example of that. I think management, they're very long-term thinkers, and that's been proved out in the share price too. So a lot of things, but you want to make sure that as a minority shareholder, you just
want to make sure
you're not going to be able to influence it. You're kind of along for the ride. So you want to make sure that the ship is being steered by capable and honest and trustworthy people.
Actually, this brings me to mind. There was another. Oh yeah, Trudy. Sorry, you keep asking so many questions, Trudy. I just wanted to say about resources. You asked about some more info on resources. We're not going to go in this because I was just saying to Andrew tomorrow I'm interviewing a very old hand in the resources materials sector, and so he'll be on the podcast in a week or so, and we're going to do an overview of the whole mining industry, as well as I've got another episode coming up talking about mining and materials and metal ETFs as well. So we will be covering it. Can be a bit of a troublesome area for some people, but
it's not my bag. But as I was saying to you, though, I mean, it's important. That doesn't mean it's wrong for everyone, but it is very important to know the areas that you are more proficient in and have a better understanding. And I think the gentleman that you mentioned, for someone who spent years and years focusing on that industry and knows those businesses. That's probably someone who I'd listen to, as opposed to someone who's going to buy a stock because there's gold in the name and gold is going up. There's first level and then there's second level thinking.
Yeah. Okay, Brian. So I think we've done the checklist. We've been through it, or the things that we haven't mentioned in the checklist. It's only because we actually did talk about them in other parts of the discussion.
It's really just common sense stuff. Do I understand the business? Do I have a handle on what kind of price is fair? Do I understand the risks? The balance sheet is in good shape, and do I trust management? It's those big kind of ideas. Buffett talks a lot about this idea of investing being easy but not simple, and it just sounds like this horribly contradictory remark, but it's not. The big ideas in investing are super easy. You could explain them to an 8-year-old. The devil's in the detail. I'm actually answering these questions. Is it a good business? And all of those other kinds of things. But conceptually, that's it. You don't need to get too much more advanced than those big ideas.
Okay, so we've got so Trudy, that was a view on resources going forward. We'll have that coming up. Oh yeah, Vinoth, another Strawman member here. Hi Andrew, another Strawman member here. Love the platform. Please include NASDAQ too. When you sell a winner, what do you factor in? So there's two parts.
Oh, okay, yeah. So yes, so NASDAQ we're all good to go for any global market. It just depends how many tens of thousands of dollars we want to pay Standard & Poor's. So the plan is always
there's a fee. There's a cost to the fee.
There's a huge cost.
Yeah.
So hopefully one day. The other part of the question is when
you sell a winner, what do you factor in?
Okay,
and there's so many factors.
Another example.
Come on over here, coming off screen a little bit.
Sorry. Another example of a good reason to talk about Pointera. Again, for illustrative purposes only. That's been, if you look at my Strawman profile, you will see that I sold some, I think, at 14 and then at 19 and 24. I've been selling all, in hindsight, horrible decision. I would have made a lot more money if I'd kept it through to today. But the reason for that was twofold. So to answer your question, what am I factoring in here? One, I'm trying to disengage myself from what price I paid, regardless of how attractive it may or may not have been. Would I buy today is always a good question to ask. And at that point in time, I was thinking, no, I wouldn't. I wouldn't pay 20 cents for Pointera today based on, and again, you'll see my reasoning on Strawman.
So hang on, if I can just clarify here. So once it gets to a point that you wouldn't buy it at, is the time to sell? Is that
I think it's time to start thinking about it.
Yeah.
People would say, oh, I wouldn't buy it now, but I'm happy to hold. Well, the market doesn't know whether you bought yesterday, you bought 10. You are holding what you are holding today, and that is your exposure going forward. So it's a heuristic, but it's a good one. If the answer is no, I would not buy this today, then you need to have a good reason for why you're holding it today. Maybe there's a tax consideration that's there. Maybe there are other factors. You just need to have a reason. Again, the market doesn't know what you bought it for. You know, and let's say you bought Pointera at 3 cents. well, whoop-de-doo. What matters today is how much is that thing worth, and that could go back to 10 cents, or it could go up to 50 cents. You need to just sort of say it's okay if it drops 50% for me because I only paid that much. That is a loss that you have made.
Yeah,
a very real loss.
Yeah, again that you have not locked in.
Right.
Yeah.
Right.
Yeah.
And that's not to suggest that you lock in profits along the way. I'm just trying to separate this idea about is having that view on value.
Yeah.
Again, not taking it too seriously, but if something jumps in a day 30% what you thought was a very optimistically formulated valuation, you have to sort of say, well, am I only holding on now because of fear of missing out on further gains, or what is? I need to articulate that.
But against that thinking is that the people, or there are sometimes a 10 bagger, 100 bagger, the serious money is made.
Yeah.
And that's only done by holding on to it as well.
Yeah. Well, this is a 10 bagger for me.
Yeah.
And and this was done over a year, 18-month kind of period. So it's not that I haven't made those gains, just that the decisions along the way have been formulated around that. I could have flipped that around and sort of say, well, I could have done that with Slater and Gordon, never sold, or you can only work with the information you have. But the second point I was going to get there is there's this waiting consideration. Now, when you have these 10 bagger type experiences, which is great, I found myself in this situation with Pro Medicus not too long ago, a couple of years ago, where it done really well for me, but then it becomes 30% of your portfolio. That's so there's waiting consideration. So to answer the question, I look at value, I look at waiting, and I also look at opportunity cost. If I'm taking that money out of the market, well, where am I going to put that?
That's right. Yeah. Is there somewhere better to put it?
Is there another company that has better risk reward proposition? So all of that goes into the mix.
So when you say the weighting, that's like your portfolio is like a pie.
Yes.
And each slice of the pie is the weighting of it, or the percentage of your portfolio. Yeah. And you don't want to be overweight in any.
You don't
want a big slice of that pie to be just in one single holding.
Not unless you have immense conviction. So that's not to say that if you've got 10 stocks, they should each have 10% of your money. It needs to be weighted according to your conviction and your sense of value. So the less risks, the more confident, the better the upside, the more weighting you can have. And I'm actually quite comfortable to have 10, 15, even 20% at times of a stock if it's one stock in my portfolio, but it has to be backed up by all of those kinds of factors.
Yeah. So you mentioned before we started that this was a fizzy pop.
A spiffy pop.
A spiffy pop. This is a technical trading term, ladies and gentlemen.
Spiffy pop comes from David Gardner, who's one of the founders of the Motley Fool. And it's a situation where the share price rises in one day by more than your cost base. So if you bought shares in Pointera at 4 cents and they went up, 10, 11 cents today, you've got a double spiffy pop, almost a threefold spiffy pop, which is really nice. But these things, Peter Lynch said really well. He said that all of his gains tend to come 3 years into his holding. And we found this, I've certainly found this with any of my big winners, whether it was Pro Medicus or EnviroSuite, or more recently with Pointera. I held them for a long time and they did nothing. In fact, down 30, 40% at times on all of this kind of stuff. These spiffy pops aren't something you buy and then 3 months later you're crowing about a spiffy pop. These are, and David himself, who coined the term, I mean, it's sort of years later that you can start talking about it, but you need to sort of stay that course. It's nice when it happens.
So, anyway, I think we've run out of questions. And what time is it? We've been on for an hour, Andrew.
Time flies when you're having fun.
Yep, we've been giving and giving and giving until we've only got a little bit left to give, and we're going to take it and eat some sushi next door. So, thank you very much for joining us. We've had several people on. That's been great. I think generally in the 30s. So, good night, everyone. We hope you enjoyed this discussion, and let us know if you want more of them, because I'm really enjoying doing these.
Me too, Phil, and thanks for organising it, and thanks for having me on. It's been a great chat. If anyone wants to catch up afterwards, or you didn't get a chance to ask a question, jump on to choose your platform. I'm going to suggest Strawman, of course, but jump on there and ask some questions. Happy to do our best to answer them.
Twitter seems to be the place where so much of this stuff happens.
A lot of good stuff on Twitter. Yeah.
Not that we've got anything against Facebook being on Facebook. We love Facebook.
Facebook's good too.
Mark, we love Facebook. Okay. Okay. Thank you very much. See you later.
Thank you.